Effective asset allocation leads to investing in the combination of stocks, bonds, and cash that has the best chance of achieving your short-term and long-term investment goals. Most investors know they can't fund their goals just by sitting in cash, but faced with low interest rates and a volatile stock market, some find themselves paralyzed by too many choices they don't understand. Hi, I'm Jason Brown with DAL Investment Company in San Francisco. We've helped thousands of investors navigate bull markets and bear markets for over 40 years. My goal in the next few minutes is to share a few simple concepts that guide our asset allocation decisions, helping us prepare our clients to weather a variety of possible near-term outcomes. And it allows us to position our portfolios to meet our clients' short-term and long-term investment goals. We'll look at what to expect from stocks, why we invest in bonds and cash, and finally, how to build a portfolio of stocks, bonds, and cash to fund all sorts of possible goals. I'm going to quickly show you some data to frame our discussion, but I don't want you to get caught up in the details. It's much more important that you see how we apply this information. If you want to review the data later, we're happy to make these slides available. Now, this first slide shows the performance of stocks, bonds, cash, and the rate of inflation from 1925 to 2009. This time period includes the Great Depression, the challenging period of the 1970s, the great bull market from 1982 to 1999, and the rather difficult decade that ended in 2009. Now, most people have seen this chart before and recognize that despite periods of volatility, stocks have delivered the best long-term performance, averaging about 10% a year compared to 6% for bonds and about 3 to 4% for cash and inflation. But looking at the yearly performance of stocks, this time for 184 years between 1825 and 2009, we can see that stock market performance isn't always average. Sometimes stocks return much better than average, like 1997, 1954, and 1933. Other times returns are much worse, like 2002, 2008, and 1931. Stock returns have been positive 70% of the time, gaining more than 20% almost a third of the time. And they've lost more than 20% only 5% of the time. Now, if we look at decades instead, between the 1930s and the decade that ended in 2009, we can see that even held 10 years, stock market returns can sometimes be negative. And measured by calendar decade, they've historically generally been well above or well below the long-term average. Now, in this next chart, we look at every possible 20-year holding period for stocks, bonds, cash, and we look at the measured rate of inflation between 1925 and 2009. In other words, we actually measured a hypothetical investment made January 1st, 1925, then another February 1st, 1925, and every subsequent month for over 80 years. We held each portfolio for exactly 20 years. There has never been a 20-year holding period when stocks lost money. That includes the Great Depression, the challenging 1970s, even the 20 years that ended in 2009. Again, some stock strategies have managed to lose money for 20 years, but a diversified portfolio of U.S. stocks like the S&P 500 index has never lost money held 20 years or longer. In fact, the average return for stocks held 20 years was better than the best performance from bonds. Bonds did outperform cash, but stocks are the investment of choice for very long-term investments. Looking at 3-year, 10-year, and 20-year holding periods between 1925 and 2009, stocks outperform bonds 70% of the time when they're held 3 years or longer, 83% of the time held 10 years, and 96% of the time held 20 years. Since stocks outperform bonds and cash most of the time, why would we invest in bonds or cash? Well, if we invested in stocks and held them for exactly 3 years at any point in time between 1925 and 2009, you could have earned as much as 200%, but you also may have lost as much as 80% of your money. The worst performance from bonds was only a small loss, and the best performance from bonds was better than the average performance from stocks. Cash basically kept up with inflation, never suffered a loss, and actually beat inflation in those rare times inflation was negative. Since we can't know if stocks or bonds will make or lose money when they're held for only a few years, very short-term goals should be funded with cash. Now, looking back at our long-term chart, we're reminded that although stocks have offered the best long-term returns, bonds have done much better than cash. Remembering that stocks sometimes lose money when held as long as 10 years, and considering that cash barely keeps up with inflation, we can see why bonds can bridge the gap between the risk of holding stocks and the limited returns offered by cash. Most investors elect a mix of stocks and bonds for intermediate term investments. Now that you can see why stocks are the best for long-term investments, cash makes sense for very short-term needs, and a mix of stocks and bonds makes sense for intermediate-term goals, I'd like to focus on how you can put this perspective to practical use. Let's pretend we have two investment accounts. The first is money we plan to spend the next year. The second account is money we know we won't touch for at least 25 years. The first account should be 100% cash, because the last thing we want to do is lose any of that money. The account we won't touch for 25 years should be 100% stocks, because stocks clearly offer the best long-term performance potential. Now let's extend this logic and pretend we open 25 separate accounts, one for each of the next 25 years. We can conclude that the first account should be all cash, the last account should only hold stocks, and the middle accounts should hold a combination of stocks and bonds. This is actually a very practical place to start for an investor retiring today who's planning to fund his retirement over the next 25 years. Let's take this a step further and see how our hypothetical retiree's allocation would change over the next several years. If we start in 2010 and end with 2035, our retiree's initial allocation would be 8% cash, 24% bonds, and 68% stocks. Remember, 1 year is 4% of 25 years. That's why the 2 years we hold in cash is 8% of our starting portfolio. Now in 5 years, it'll be 2015. We'll be closer to 2035. And as you can see, our new allocation would be 10% cash, 30% bonds, and 60% stocks. The reason the cash allocation increased is that the same 2 years is now 10% of the 20 years that are left. You can see that as we continue to walk through time, we're crossing off the years on the right side because we still need 2 years held in cash. We need to eliminate only the risky side of the portfolio. You can see our retiree now needs to hold more cash and bonds and less in stocks. These same principles can be applied whether you're investing to pay for a child's education, to pay cash for your next car, to fund almost any investment goal. Now I know some of you have been traumatized by the volatility of the stock market since 1999, and others are concerned about a potential bond bubble and ongoing economic challenges. Despite those concerns, I hope you will use this information to build an asset allocation that can help you achieve your investment goals. DAL Investment Company manages investment portfolios designed to capitalize on changing markets. We even manage a series of no-load mutual funds. We also publish a highly rated newsletter called No Load Fund X. If you need help with the information discussed today, want to learn more about our services, or to access other free insights, please visit our website, call us, or send us an email. Thank you for watching.